Good day. This is Milton Flanagan with Flanagan Financial Services. Your beneficiaries might pay more in taxes. Wonder how? Did you know that your beneficiaries could end up paying more in taxes when they inherit your qualified accounts, such as an IRA, 401k, 403b, or deferred comp plan? Would you be surprised to learn that non-spouse beneficiaries, such as your children, grandchildren, could end up paying significantly higher income taxes when they inherit those type of assets? You could ask, how could that be? Well, the rule changes with the Secure Act could be the reason. The way the current law is written, non-spouse beneficiaries have to deplete those qualified assets by December 31st of the 10th year after the passing of the original owner. While you could withdraw the funds at once, be careful. There are several obstacles that you might need to consider and which might alter how and when you decide to withdraw that over that 10-year window. First, let's assume the beneficiary is 60 years old. Let's also assume that the person inherited $250,000. Not an unreasonable amount of money. Here is where the questions and planning become very important. There are several options that depending on the individual situation. First, they could close the account, pay the tax on the $250,000 and call it a day. In doing so, they just increased their income for the year by an additional $250,000, which most likely is going to increase their tax level at the federal level and depending on the state, possibly at the state level. This could cost anywhere between $40,000, $60,000 or more in income taxes. Your non-family uncle, Uncle Sam, received about 25 to 30% more of the money that you were left. Second, you say, well, I'll just start taking $25,000 a year over the next 10 years. That'll solve the problem. Well, maybe or maybe not. If the person is single and their current income is about $80,000, then now they run the risk of potentially paying income taxes on over $100,000 of income, which might place them in a higher tax bracket. This could be a good strategy, but let's also assume that the person is going to be taking Medicare at age 65. What could this possibly happen, or what possibly could happen to their Medicare premiums? Well, if they continue to work, since their scenario is going to be more than they're going to earn more than $92,000 a year in, say, 2022, they not only possibly pay higher income taxes, they may also pay higher Medicare surcharges of almost $1,000 more a year. Well, in this case, Medicare will look back 2 years to calculate the surcharge. So what is one to do? Here's one of several options. Don't take any withdrawals until you're ready to retire. Your income might be lower, and at that point, possibly you do not begin taking your Social Security benefits until age 70. And assuming you still have $250,000 on account, when you begin drawing Medicare surcharge limits, assuming you don't have any other income, so in this case, the person could withdraw roughly $90,000 at ages 67, 68, and 69, assuming they have no other income for it. And based on those facts, if it's the only income, then the income tax due might not be much different than their current working income for it, and they potentially avoid the Medicare surcharges. In implementing a strategy like this possibly allows several other things to happen with these proceeds as well. First, the individual's Social Security benefits potentially increase because they postponed when they took Social Security. Two, possibly their own retirement accounts grew over the same period of time, meaning they might have more of their own money saved up that could generate more income for it. And three, they now may be in a position where their standard of living is unchanged since possibly their other income assets had the opportunity to grow and change and generate more income. Discussing your income options with your financial professional such as myself, we might be able to help navigate through these murky waters. There may be a myriad of other strategies, both current for the current owner as well as for the beneficiary, but without developing a sound plan, you might end up paying more in taxes, potentially Medicare surcharges, than you need to. If you believe you could benefit from such a plan, a detailed conversation, please feel free to give me a call, Milton Flanagan, at 630-235-5273, or you can email me at mflanagan, that's F as in Frank, Lanagan, at FlanaganFinancialServices.net. And we can discuss more about how possibly we can keep more money in your pocket and out of your Uncle Sam's pocket. Remember, just because it's easy doesn't mean it's the best way to go. Potentially, with proper planning, we might be able to achieve both goals. This is Milton Flanagan, Flanagan Financial Services. You have a great day.